Hello everyone. Let's do a practice problem where we analyze the variances, book them under a standard costing system, make our standard cost income statement, and ultimately close those variance accounts for a company called Impervious Travel Mugs. We have some information to work with provided to us in this question. Firstly, for the sake of simplicity, let's assume that they only produce one product, an indestructible metal travel coffee mug. You would have to do a variance analysis for all sorts of different products. If you can do it for one, you can do it for a ton. We'll just do it for one particular product. We have the information provided below about these standards and actual amounts that they've paid for all of their inputs as well as their production for the month that ended December 31st, 20XX. We're going to assume they use direct labor hours as their cost driver for allocating overhead, and they use a simple costing system. After all of this has been calculated, after we determine all our variances, we're going to record the necessary entries, make our income statement, and ultimately close our variance accounts to the company's cost of goods sold account for the period. So what information do we have to work with? Well, at the beginning of the period, the people running Impervious Travel Mugs would have went through and they would have set standards for how much goes into each mug for all sorts of things. And what they have here, firstly, is they think each mug is going to take 1.5 pounds of metal. The purchasing manager has determined that the cost of acquiring the metal to make these mugs is going to be approximately $3 per pound. The production supervisor has determined that it's going to take about a half an hour to make each and every mug, and the people in HR have determined that the average labor making these mugs is going to make $15 per hour. They went through and they determined their predetermined overhead allocation rate for both their variable overhead costs and their fixed overhead cost. Again, by estimating what the total amount of variable overhead was going to be, what the total amount of fixed overhead was going to be, and what the total quantity of their driver, in this case direct labor hours, was going to be, figured out what the predetermined rates are there: $4 per hour for variable and $4.50 for fixed. Well, what actual events happened during this period? Impervious made 10,000 units. They went through 15,500 pounds of metal to produce those 10,000 mugs. Their average cost to acquire the metal to make these mugs was $2.90. They spent $78,128 in direct or inventoriable, if you will, labor costs during the period because their workers worked 5,140 actual labor hours and made an actual average rate of $15.20 per hour. Their actual variable overhead cost for the period ended up being $20,960. And while they had originally budgeted for $23,000 in fixed overhead costs, something changed, and they ended up having actual fixed overhead costs of $23,800. The company had estimated, based upon their selling price, that they were going to generate $200,000 in sales revenue for the period, but they actually ended up generating $208,000 in sales revenue, so better than predictions on that one. And then lastly, they incurred $25,162 of actual non-manufacturing costs, which could not be inventoried to the production of these mugs, but still counts against the company's operating income for the period. So now that we have all our standards and we have all of our actual results over here, the first step that we need to do to go through this process is to determine our variances. And the first one that I like to start with is direct materials variances. We need to isolate out the portion of what the difference was between what actually happened and what should have happened according to our flex budget into what portion of that discrepancy could be attributed to a change in the price of our direct materials that we had to buy to manufacture, and a change in the efficiency, how much we used of the direct materials in comparison to what should have happened according to our flex budget during the period. So to do this, we're going to figure out what our actual costs were for that particular input, what they should have been had we hit our standards and our flex budget, and then we're going to isolate out the difference between price and efficiency by making the no-name column, if you will. So let's start over here with our actual direct material cost for the period. This is found by taking your actual input quantity, how many pounds of material you used, and multiplying it by your actual price, what you paid on average per pound during the period. Well, if we go back to our info, we see over here that we actually used 15,500 pounds of metal, and our actual price was $2.90 per pound. So if I multiply those two numbers together, I get our actual total cost for materials during the period. And we determined that Impervious Travel Mugs actually spent $44,950 on materials during the period. I'm going to go over and do the flex budget right now. And the flex budget is what should have been. What should have happened if we made the actual amount of units that we did, but we used the amount of material for each one of those units that we had proposed in our static budget, and we paid the price per pound of material that we had proposed in our static budget. In our info, it tells us that Impervious actually made 10,000 units. Well, they said at the beginning of the period that each one of those units should take 1.5 pounds of metal, and the price of metal should be $3 per pound. So, with that information, if I go through and I multiply our actual production times both of our standards for the portion of production that we're finding the variance for, in this case materials, the 1.5 pounds of metal per mug, and the $3 per pound that we were going to pay, we determined that had they actually went through 1.5 pounds of metal per mug and paid $3 per pound and made 10,000 mugs, if we hit our standards, it should have cost Impervious $45,000 right on the dot. Well, that's only a $50 difference. That's our flex budget variance over here. I can go and fill this in at the bottom, which seems pretty good. I mean, we spent less actually than we should have according to our standards, but that's not enough information to really assess your production, assess, the status of your company, how well you're doing. Because that could be the offset that we have between the severe increase in price and a severe increase in efficiency. So why don't we go and we figure out what's our price variance and what's our efficiency variance. And to do that, we're going to need the no-name column. And the no-name column is just our actual input quantity. In this case, since we're doing materials, the actual amount of materials we use times our budgeted price. And it equals, I'm going to go back to my info and see that our actual input quantity, the actual amount of materials that we used, was 15,500 pounds of metal. And our budgeted price was $3 per pound. And that is 46,500. And now, since both of these sides are comparing actual input quantity, we're just analyzing the difference between our actual price and our budgeted price. Since both of these sides are using our budgeted price, the efficiency variance is analyzing only the difference in the actual quantity versus what should have been in terms of how much material we used. And now I can find my variances by subtracting the right number from the left number. So 44,950 minus 46,500 is a negative of 1,550 bucks. 46,500 minus the 45,000 that we had in our flex budget gives us an efficiency variance of 15,000. Are these favorable or are they unfavorable? Well, this 15,050 says that we actually spent less than we should have. And if we compare our actual price to our budgeted price, our actual price was $2.90. Our budgeted price was $3. Absolutely, we spent a dime less, if you will, for every pound of metal that we used. That's very favorable for our bottom line. In spreadsheets, in Excel, up here at the top in the style section, you get a whole bunch of things, but there's ones on the top that say good and bad. Well, having to spend less on materials in terms of price per every pound of material you acquire is a good thing for the company's profitability. So I'm going to use the good filter, if you will, to denote that is in fact a favorable variance. How about over here? What do we have? Well, now we're using the budgeted price for both, which means the difference here is in the quantity of materials that we used. If we use the quantity that we set forth in our standards for each mug that we made, we should have only spent $45,000 on materials. But over here, when we adjust it to the actual quantity that we used, we see we had to spend $1,500 more to acquire materials. We used more materials than we had predicted. Well, that's bad. That's no good. And overall, our flex budget variance, we actually spent $50 less than we should have. So that guy, he's good for us. He's favorable. We're going to use the good filter on that. So we've analyzed what happened with our materials. Sure, we spent a little bit less overall than we should have, but the question is why? And the reason why is, firstly, we saved on our per pound price for the metal that we needed for the mugs. But that savings was almost entirely offset by the fact that we had to use more metal than we had planned in the beginning. So what could have happened for that efficiency variance to be so unfavorable? Perhaps we bought a batch of metal that was not proper. Perhaps we went through and we made a batch of mugs and they came out defective and we had to throw them out. And to fulfill our orders, we had to make even more mugs. Something could have happened, but we ended up using more metal than we thought we did. Let's move on and do variances down here for direct labor. And it's the same setup. We're going to start with our actual cost, which is our actual input quantity of labor hours times the actual price we paid on average to each laborer for every hour they worked. So if I equals and I go back to my info, our employees actually worked 5,140 hours. They actually made $15.20 per hour. If I multiply those two numbers together, I come up with $78,128. That's what we actually spent on labor during the period. Well, if we hit both of our standards, and that's the standard for how long it was going to take to make each mug, and the standard for how much our employees should be making on average for the skill level that's necessary to produce these mugs. If we hit both of those standards for our actual level of production of 10,000 mugs, what should it have cost? Well, let's go back to our hit equals and go back to our info. 10,000 mugs, having each one take half an hour, would have taken 5,000 hours. If we multiply that by $15 per hour, we're proposing our employees were going to make on average. Well, then production of those 10,000 mugs should have cost us $75,000. So again, our flex budget variance is our actual results less what should have been. And we see that we spent $3,128 more on labor costs than we should have had we hit our standards. Spending more is never good for a company's profitability. That is unfavorable. We're going to denote that that's bad. Well, what a portion of that $3,128 can be attributed to a change in price? Maybe there's a cost of living increase. We had to pay our laborers more than we thought we did. Or labor inefficiency. It took our employees longer to produce that amount of mugs than we thought it would have when we set our standards. So to do that, we're going to need our no-name column. Actual input quantity times our budgeted price. When we hit equals, I'm going to go find our actual input quantity, the actual amount of hours our laborers worked, which is 5,140. And I'm going to multiply it by the $15 per hour that we were proposing we were going to spend on labor. And that comes out to be $77,100. So again, both of these numbers were computed using actual input quantity, which means this difference is purely attributable to the difference between our actual price and our budgeted price. And our direct labor price variance in this instance is that we paid a grand total of $1,028 more than we should have, which can be attributed to the fact that our actual average hourly labor price was higher than we budgeted for. But paying more is still not good for your company. That's unfavorable. What about over here? Well, we've got our efficiency variance. Both of these take into consideration our budgeted price. We're assuming, that's every labor made per hour what we had budgeted for in the first place. Therefore, that difference between these two numbers is purely attributable to the difference between how many hours we should have taken to make our actual production, our budgeted input quantity adjusted for actual, if you will, and the actual amount of hours our laborers worked. So I'm going to take the no-name column, I'm going to subtract out our flex budget amount, and I come up with $2,100. We actually spent $2,100 more on labor costs than we should have according to our flex budget because our workers were indeed inefficient, and that's very unfavorable for our company. And our efficiency variance for direct labor and our price variance for direct labor add up together to our total flex budget variance for direct labor. So we had a bad number there. And why is that? Well, a little bit's to do with the fact that we paid people more, and a lot of it's to do with the fact that it took our employees longer to make those units than we had originally estimated. We have two other cost components to go in. Our overheads are other cost component. We're going to break it into two different groups, what's variable and what's fixed. We'll start with variable. What were our actual variable costs? This is provided to us in the information. So if I go back to my info and I find our actual variable overhead costs, it is $20,960. That is the actual amount of variable overhead, indirect materials, indirect labor, maybe some kind of variable depreciation, then impervious travel mugs incurred during the period. Well, over here in the allocated section, we're using a standard costing system, which means when we put stuff on the books, when we move costs through our inventory accounts, we're not doing it at what had actually happened. We're doing it at the standards that we had set forth in the beginning, which means if I take the actual amount of units that we produced and I multiply it by the standard amount of the cost driver that each unit should have taken, and I multiply that by the allocation rate that we had predetermined for variable overhead before the period started, I would get how much is going to be allocated under the standard costing system. So I'm going to hit equals. I'm going to go to my info, and I'm going to multiply our actual production level of 10,000 times the standard quantity of the driver that should have went into each unit. Again, our driver given in the information is that we use direct labor hours, so the actual or the standard quantity of the driver that should have went into each unit is half an hour, and our predetermined overhead allocation rate for variable overhead at the beginning of the period was determined to be $4 per hour. So if we were allocating in our costs at a rate of $4 for every labor hour, and we spent as long as we proposed we were going to make those 10,000 units, well then under our standard costing system we will have allocated $20,000 of variable overhead to mugs during the period. Well, what's our flex budget variance? It's the difference between what actually happened and what should have been according to our flex budget. And what should have gone in there, the amount we're going to record under standard costing system, is $960 less than what actually happened, which means we spent $960 more on variable overhead than we allocated, than we estimated for. Well, what portion of that is attributable to the fact that one of the inputs of our variable overhead went up? The cost of indirect materials went up to buy, the cost of indirect labor went up to pay for, like the per unit or per hour or per pound rate increased, and what portion of that has to do with efficiency? We did more of the thing, in this case direct labor hours, that causes us to incur variable overhead, the quantity of our driver. Well, to do that, we're going to have to isolate it out using the no-name column, and we're going to take our actual input quantity, how much of the driver we actually used, and multiply it by our predetermined overhead allocation rate that we budgeted for variable overhead. So going back to our info, the actual amount of the driver that we used was 5,140. We had proposed that we were going to allocate at a rate of $4 per hour. So for the actual level of the driver that we incurred and our predetermined or budgeted overhead allocation rate for variable overhead, that is $20,560. And now I can break down that $960 difference that we have into what portion of it can be attributed to a change in our spending for variable overhead, and what portion of that variance that we have can be attributable to the fact that we had to use more or less of the driver than we had proposed. So our spending variance is the difference between actual and our no-name column, and that is $400. The efficiency variance is the difference between our no-name column and the amount that we have allocated using our standard costing system, and that's $560. So we, even at our budgeted rate, because we use more labor hours, incurred $560 more in variable overhead costs, which means that is an unfavorable variance. We spent $400 more in variable overhead because the price of some component of our variable overhead increased on a per unit basis during the period, and if we add together our $400 unfavorable variable overhead spending cost and our $560 unfavorable variable overhead efficiency variance, well, that totals up to the $960 unfavorable flex budget variance that we had for variable overhead. Then moving on, lastly, for our variances to our fixed overhead variances. We're going to start with our actual. What was the actual amount that we incurred of fixed overhead during the period? Well, that's provided in our information. Our information tells us that Impervious travel mugs actually spent $23,800 in fixed overhead costs during this month. Typically, in the no-name column, you would adjust for a change in your input quantity. Well, that is irrelevant for fixed overhead because, again, fixed overhead should not change no matter what happens with the quantity of your driver. So in the center column for this one, we don't really have a no-name-ish column. We're just going to bring over the amount from our flex budget. We propose to spend $23,000 on budgeted fixed overhead costs during the period. Now over here, we're going to determine what amount of fixed overhead would be allocated to our actual level of products that we made during the period under the standard costing system. And again, in the standard costing system, we allocate based upon what should have been adjusted to our actual production levels. So let's go to our info and let's take the actual amount of mugs that the company made, which was 10,000. Multiply it by the amount of the driver that we had predicted at the beginning of the period was going to go into each mug that we produced, which was, since our driver is direct labor hours, a half an hour of direct labor. And then we'll multiply that by our allocation rate for this particular type of overhead, which was $4.50 per hour. So if we have been, while we produce those 10,000 mugs, allocating at a rate of $4.50 per hour, and recording at the standard of half an hour for each mug made, it means that $22,500 worth of fixed overhead has been allocated to products during the period. Well, what is our flex budget variance over here? What is the big number that we have? It is our actual costs minus the amount that we have allocated. That is $1,300. What portion of that is attributable to spending, which means something that we thought was going to be fixed, that was going to cost a certain amount. Maybe our landlord said $23,000 in rent and increased it to $23,800. Like something happened during the period where one of our inputs that we assumed was going to be fixed went up. And it didn't go up because we made more or less units. It went up because whoever we pay for that cost increased the price on us. We spent $800 more in fixed overhead than we should have according to our flex budget. And I don't like the formatting on that. Let me go and fix that really fast. There we go. The production volume variance means that we didn't allocate in as much overhead as we should have using our standard costing system because our actual production volume differed from our expectations. Well, we had a flex budget amount of $23,000. The amount that we have allocated over here is $22,500. Which means we have $500 more to put in there than we, would have allocated under the standard costing system. And all of these, because they're positive numbers, I'm going to hold down Control and click all three of them at once, should be unfavorable because we know that no matter what gap we take, the price is going up between the amount that we allocated and our actual costs.